Good morning and welcome to the Global Morning Call. Today is Thursday, 5th of April, 2018, and we start with an FX update with John Hardy.
Thanks, Yasser. Yesterday clearly about sort of a great example of a textbook example of headline whiplash. As we first had the Chinese announcement of potential tariffs on up to $50 billion worth of U.S. exports into China, and then the later subsequent comments from U.S. Trump administration officials sort of saying, in effect, these are just negotiating tactics. These tariff suggestions from the U.S. side are out for comment, and there were even some friendly remarks from the U.S. ambassador, the Chinese ambassador to the U.S. on the matter as well, suggesting that I think from the market's point of view, the equity market's point of view, that if things get too serious on the trade confrontation front, and you see equity markets getting spiked, that negotiations will suddenly become the theme rather than a trade war. So overseeing, of course, is a risk appetite bounce back. In FX, the whole effect was pretty muted relative to what was going on in the equity market. We did see a risk-off response yesterday, and the yen rallying, etc. But by the end of the day, with that being reversed, the FX moves were also reversed. And I think the most salient theme is a weak euro, even weaker Swiss franc, and weaker Japanese yen. These are the currencies that are on the defensive, and I think will remain on the defensive if we continue to see recovery in risk appetite. So we pointed out the dollar yen recovery. It's actually trading above 107 just before we started this morning meeting. I think that's an interesting area up towards 107.50, and I think we risk challenging the validity of the downtrend at even higher levels here if U.S. yields continue higher, and the key factor there will be the U.S. jobs report tomorrow. As well, dollar Swiss staring down its 200-day moving average, and I have the euro dollar chart here. We've seen 5 consecutive weeks of near doji sort of candlesticks. I have a hard time imagining we close this week for a 6th consecutive sort of non-directional moves. And I think the risk is, given positioning, a bit to the downside, at least for a further consolidation test, perhaps at the 120 level. We'll see. But I think, again, if this risk recovery continues, your three currencies here will be the weaklings, and the other currencies in varying degrees stronger versus those. Of course, focus on the Friday jobs report. Nothing suggesting that it'll be anything but strong. There'll be considerable focus not on the payrolls and whether those are strong once again, but more on the earnings front after we had the 1-2 of January seeing wildly stronger earnings than expected, and then those revised down slightly, and then a slightly weaker number in February. So where do we see the March data? Will be the key question there for tomorrow. Today, more minor stuff, Eurozone's final services PMIs. We've already had a peek at the flash levels there. Eurozone economic data surprises have been tending negative. We have the latest weekly claims, and then a Fed voter out speaking later today. April 27th, I've highlighted this Bank of Japan meeting coming up on April 27th, simply because the Bank of Japan indicated that it's in discussions on how to eventually, internal discussions on how to eventually unwind its policy. So keep an eye on that. And for now, I'll send you along to Peter on equities.
Thank you, John. So the big thing that happened yesterday was with the headlines coming in from China, and then afterwards from the White House, which made a soft signal on the trade policy, and we had a global rebound in global equity markets and risk in general, as John mentioned. My take is that the noise to signal ratio will continue to be extremely high for the coming months on this whole trade policy. I think the main question is whether the U.S. and China is on a general collision course here. I think the probability is definitely going up month by month for that thesis. If that is to be the case over the long run, then this whole trade policy is just one thing, and we'll see other things be negative for markets going forward in the relationship between the U.S. and China. On the positive side, or this positive spin on this, obviously, is that the U.S. and China are very much dependent on each other through the trade, and that typically often leads to a less confrontation. So that could be the positive spin on it. But for now, expect noise to the signal ratio to be extremely high. The emerging markets ultimately were the biggest loser yesterday. In the beginning of the session, they recouped a lot of the losses, and I suspect emerging market equities to be the winner today. Definitely benefiting. This segment is the biggest beneficiary of globalization and free trade. The ADP has pointed yesterday to very strong labor market results in the US. We will see. I suspect that we will see a very strong non-farm payrolls on Friday, so that's not the big surprise. the key focus will still be on the hourly earnings growth, as John mentioned, because it filters directly into interest rates and then into all other asset classes. There's a lot of data points now that suggest that the slack in the U.S. labor market is almost completely gone now. So it would be a big surprise if we don't get that uptick in wage growth over the coming months. And then Tesla and Facebook continues to be in focus in the technology sector. I will just briefly mention that our view on the whole electrical vehicle space, I've talked about that with clients in Asia, and whenever I talk to clients, that our view is that the automobile, so the end line of the supply chain, is not where the profit is going to be made. We think that that investors will profit from the EV adoption through battery technology. So that's definitely where to look at, and we'll give ideas going forward. And then Facebook has just announced that potentially to upwards around 2 billion users of data could have been vulnerable to scraping. So maybe it's going to be much more than the 87 million already mentioned. I don't think the negative sentiment on Facebook will go away anytime soon. So be on your toes if you have a long exposure there. And with that, I'll give the word to Ole on commodities. Thank you.
Yeah, and obviously continuing the theme from yesterday, the on-off focus on trade tensions was ripping through commodities yesterday, and what we really saw was it was very much a lot of it was fund driven. So where longs had been building up got hit, where shorts had been building up got bought. The long side especially hit crude oil, where there's been a build up in recent weeks because the focus has been on potential supply disruptions that hurt crude oil pretty hard before recovering later in the day. And also, if you saw the grain markets, there was some quite bullish numbers for corn and soybeans last Thursday, which helped drive the market higher, and that attracted quite a lot of buying. And those were caught offside yesterday. So, but let's take a look first of all at crude oil. It continues to take its cue from stock market movements, especially related to these current trade tensions. I think the market does remain range bound. We did not quite make it to the area of support I was looking for yesterday, but WTI did have a strong bounce, and followed by Brent later in the day when we saw the inventory data, which showed a weekly drop, which was in line with what the API had reported the day before. The drop was primarily driven by a record U.S. exports and lower imports, so it's not. So that obviously will continue to keep U.S. stocks at bay when exports are rising at that kind of speed. But the range-bound nature right now is really driven by the opposition outlooks for where we have OPEC production discipline, falling Venezuela production, and potentially the Iranian sanctions threat being offset by potential growth-harming protectionist policies from China and U.S. So on that basis, the market is likely to remain range-bound. But looking at the chart, just like we're seeing on many of the chart patterns yesterday, gold and oil, crude oil's got quite a bullish candle yesterday, and gold had a bearish candle. And that means that gold is probably looking for support now after failing to once again challenge this $20 area of resistance above 1355. The strong build in speculative longs, as I mentioned, and weakness across the white metal, silver, platinum, and palladium is creating some concerns in the market at this stage. So we believe that multiple uncertainties are likely to attract buyers into any correction. So at this stage, we're focusing on 1321, followed by 1312. Grains was really attracting most of the attention yesterday. There was a big washout, especially in soybeans. You can see the chart over here. At one stage, we were down 5% on the day. It was China decided to target their soybeans imports from the U.S., which is huge. Something like 70% of U.S. exports of soybeans goes to China. It's amounting to around 35 million tons. But obviously, the world supply and demand outlook doesn't change. There's still mouths to feed, both animal and human, and that means that China will continue to need to import these quantities. And with South America currently struggling to meet that extra demand, they will need U.S. imports, and that can only mean that there will be rising cost pressure in China from the 20% tariff. So again, there is probably a likelihood that some kind of agreement can can be struck, because it is going to be hurting on both sides. But it is going to be a make or break where a few weeks here for U.S. farmers. They are obviously it's catching them at a very, very bad time of year. They are just about to start planting. Some have already bought their seeds, so they cannot make any changes to what they planned. But if we continue to see some relative pressure on soybeans, we could see some of the acreage being switched towards corn, and that means we should keep a close eye on the ratio between soybeans and corn. It's currently testing support to the downside at 252. So if it goes lower, that means corn will go up in relative value. And that could potentially attract some more planting into corn. But a very critical few weeks, so that's worth to keep an eye on. That's it for me. Have a good day.
Thank you, Ole. And just to round up, there is a risk recovery in the market following the U.S. or following the trade war whiplash. This is on the currency market, affecting mostly weaker euro, Swiss franc, and Japanese yen. The dollar yen is trading above the 107 area, with 107.50 the next technical resistance area. With higher US yields, this could lead to more weakness in yen. Euro dollar is trading around the 122.70 technical support area. A weekly close below that could open up for further weakness in the euro dollar. Emerging markets could be the biggest winners following this risk recovery, but we remain cautious in general, and mostly on Tesla and Facebook. Gold has also been weakening on the stronger risk recovery. Technical supports around the 1321 area, and followed by the 1312, where we expect these areas to attract buyers. Have a nice trading day. Bye bye.